So I have a question for you. What if I told you Vanguard, one of the biggest investment companies in the world, has surveyed their investors for the past 8 years and asked them, what do you think the stock market is going to do over the next 12 months? What do you think they found? Were the investors good at predicting the market? Did they get better over time? Were they at least in the ballpark? Nope, nope, and nope. Almost every single year, the investors got it wrong. But here's the really fascinating and kind of wild part. The predictions were wrong in a very specific and very predictable way. And that pattern, it is costing everyday investors real money. So today, I want to break down exactly what was happening, how our brains are kind of hardwired to make these mistakes, and most importantly, what you can do about it. And I promise you, the solution is so much simpler than you may think. In fact, the solution for most people is to do nothing. But we'll get to that. Let's talk about what the Vanguard study actually found. Year after year, when investors were asked to predict how the stock market would perform over the next 12 months, the single strongest predictor of their answer was how the market had performed over the past 12 months. If it had been a good past 12 months, they predicted that the stock market would continue to go up. However, if we had a rough 12 months and the stock market was down, the vast majority of predictions was that the stock market would continue to tumble. And again, it's almost always wrong. Behavioral scientists have a name for this. It's called extrapolation bias. That's just a fancy way of saying, hey, we're going to take whatever just happened and assume that it's going to keep happening. Here's some examples of how that played out. Think back to late 2021. Markets had been on an absolute incredible run. The S&P 500 had returned about 28%. Investor sentiment surveys were sky high. Everyone was feeling great. The prediction? More of the same. Then 2022 happened. The S&P 500 dropped about 18%, one of the worst years in recent memory. Then flip it around. By the end of 2022, investor sentiment was at near historic lows. After a brutal year, people were bracing for more bad news. The predictions were deeply pessimistic. And then 2023 happened. The S&P 500 rallied nearly 24%. So investors were bearish right before some of the best times in recent history. They were bullish right before some of the worst times in recent history. This is the extrapolation bias in effect. And if you're making moves based on how you feel, it gets very expensive very quickly. Now I want to give your brain a little grace here. It sounds like we're being a bit irrational, but we behave this way because we're human. Here's what's going on. Our brains have something called recency bias, so we give greater weight to the more recent events. And from an evolutionary standpoint, this made a lot of sense. If a lion showed up at the watering hole yesterday, assuming it might show up again today could literally save your life. But when it comes to the stock market, this same mental shortcut can be a trap. Because the stock market is not the same thing as a lion at the watering hole. Looking at the stock market's performance over the recent history and then assuming that that same pattern is going to continue in the near short term is an expensive trap because we have no guarantees here. We have another psychology term here. There's also something called availability heuristic. We judge how likely something is to happen based on how vividly we can remember an example. So if we think back to a recent crash, that feels scary. That creates a stronger imprint on our memories. But instead, if we were to try and think of a slow and steady decade-long climb with the stock market, that doesn't imprint itself as strongly. So basically, our brain overweighs the dramatic stuff. 8 years of investor expectations data showed that forward-looking market predictions were anchored almost entirely to trailing 12-month returns and were wrong the vast majority of the time. And here's the thing, we're not even aware we're doing it. So often this becomes a blind spot for us. We're pretty good at spotting other people's blind spots, but when it comes to those for ourselves, not so good. So this is just our brains doing what our brains do. But here's the thing, once we understand this pattern, we can work with it. Okay, so we know the predictions are wrong, but does that actually cost people money? Let's look at the numbers. Morningstar publishes a study every year called Mind the Gap. And when you compare two things, the return a fund actually earned and the return the typical investor within that fund experienced, they're generally not the same. The average dollar invested in U.S. stock funds and ETFs earned 7% per year over the 10 years ending in December 31st, 2024. But those same funds earned 8.2% per year. That's a 1.2 percentage point gap nearly every single year. And Morningstar found that this is because of investors buying and selling at the wrong time. Now, at first, 1.2% might not sound like a big deal, but let's run the numbers. Might turn out to be a bigger deal than you might think. Morningstar also found that this 1.2 percentage point gap represents roughly 15% of those funds' total return over that 10-year period. Investors were essentially leaving 15 cents of every single dollar of return on the table simply because of how they were moving their money in and out of the fund. And here's one more important thing. Morningstar has found that this gap is remarkably consistent. They found it in every single 10-year period, ending in 2020, 2021, 2022, and 2023. This is not a one-time blip. The 1.2 percentage point gap is consistent across multiple 10-year measurement periods, and this suggests this is a durable behavioral pattern. Let's say you invested $100,000 in the U.S. stock fund 10 years ago. If you had earned the fund's actual return of 8.2% per year and just left it alone, you would have ended up with roughly $219,000. But if you moved this money around and ended up with the average investor return of 7%, because you leaned into predictions and gut feelings, you would have ended up with roughly $197,000. That's a $22,000 difference on a $100,000 investment, and that's because we're leaning into our predictions and our gut feelings. Now let me show you one more piece of data. An investor who stayed fully invested in the S&P 500 over the 20-year period from 2003 to 2023 earned approximately 9.8% per year. Missing just the 10 best days during that entire 20 years cut that return to about 5.6% per year. 10 days out of 7,300 days in a 20-year stretch. Missing just 10 days, less than 2 weeks total, cut your annual return nearly in half. And those best days tend to cluster right around the worst days. The biggest upswings, those biggest daily upswings, tend to happen during or right after the scariest moments. So the investor most likely to miss the best days is that exact same investor who looked at their portfolio in the scariest moments and their gut said, oh my goodness, this might continue, and they moved their money and they stayed in cash. And the cost of acting on that prediction, leaning into your gut feeling or that reaction, also costs you the recovery. Okay, so we've established that predictions are usually wrong, and acting on them is costing you real money. So what should you do instead? Well, here's where I get to tell you something genuinely wonderful. The answer for most people, most of the time, is to do nothing. And I mean that seriously and with full scientific backing. Doing nothing deliberately and intentionally is one of the most powerful forces in personal finance. Behavioral economists call this inertia. And Andy Reid, the head of behavioral economics research at Vanguard, put it this way: nothing is the most powerful force in behavioral finance. Inertia simply describes what people tend to do, and you can harness it to work in your favor. Here's an example. 401k plans with automatic enrollment have participation rates around 90%. Plans where employees have to opt in themselves have participation rates closer to 60%. Same employees, same benefits, same fund options. The only difference is the default setting. That gap, 90% versus 60%, is simply about the default setting. It has nothing to do with superior financial knowledge. If you have automatic enrollment, inertia is likely to keep you in. If you have to opt in, inertia is likely to keep you out. There's a famous study by Eric Johnson and Daniel Goldstein called Do Defaults Save Lives that looked into organ donation rates across European countries. 2 neighboring countries, Similar demographics and roughly similar people. One had an opt-in system, one had an opt-out system. The opt-in country had donation rates near zero. The opt-out country, nearly 100%. Defaults are everything. So let's make this apply to you and your investments, because the best investment plan is one that works with inertia. Take target date funds, for an example. You buy one fund matched to your target retirement year, and it automatically rebalances itself. It automatically shifts from more aggressive to more conservative as you get older. You do nothing and inertia works for you. Automatic rebalancing works the same way. You set it and forget it. No matter what the market does, you don't have to make any decisions. And dollar cost averaging, investing a set amount every single month, is another example. You're always investing. You're not trying to predict what the market is doing. You're not making a decision. You're just investing, no matter what. Allocation funds, which include target date funds and balanced funds, showed smaller investor return gaps than sector or specialty funds. The simpler, more automated the fund, the closer investors came to capturing the full return. The funds where investors did the worst, they're the ones that required the most active decision making, the ones that tempted people to time the market. If you're watching a fund and the market on a moment-to-moment basis, you're giving yourself more opportunities to screw up your plan, to screw up your compounding. All right, so what can you actually do? How do we build something that you can act on and incorporate this into the rest of your life? Step 1, check if your portfolio has drifted. Look at how your portfolio currently stands compared to your original setup. If originally you intended to have 70% in stocks and 30% in bonds, if over time, say we had a strong market performance, you find that the stock portion of your portfolio now makes up 85% of your portfolio, maybe that feels like too much risk. Maybe inertia and not touching it has caused your portfolio to drift into a position where it's more risk than you want. And in that case, you can rebalance, but you're doing it by a set amount of rules and a playbook that you've designed rather than reacting to the market. And if you're curious, I do have an entire video dedicated to the act of rebalancing and the different ways you can actually do it, because I feel that it often doesn't get talked about. So I'll link it here to check out. Step 2, you could turn on automatic rebalancing if you haven't done so already. Most brokerage accounts or all-in-one platforms do have this option. You simply turn on automatic rebalancing and it will be done either on a calendar basis or when your portfolio drifts beyond certain thresholds. And one thing I always like to mention when we talk about rebalancing is that when it comes to rebalancing, we're not doing this in an attempt to chase superior performance. When we rebalance, the intent is to keep the risk exposure of our portfolio aligned with our risk tolerance. Step 3, if you're in a 401k, check your default investment. If you rolled over to a new account or you're a new investor, you might find that you've been defaulted into a money market fund. So your money might not be doing much. Many accounts these days will default new investors into target date funds rather than money market funds. And this is wonderful because it gets people invested and participating in the market. But make sure you look at what you're actually invested in, because you want to be invested in a way that resonates with you. Step number 4, zoom out, literally. When you feel an urge to make a prediction based on how the S&P is performing in the recent past, pull up a chart of the S&P performance. Go back 50 years or 100 years. Look beyond the past 12 months. Look at that full timeline. Corrections happen, recoveries follow. The long arc bends upward. This visual is genuinely calming and it is backed by data. Number 5, automate as much as you possibly can. Automate your contributions, automate rebalancing, automate every piece you can of your investment portfolio. The more you remove yourself from actively making decisions, the less chance you have to screw it up. Here's the big takeaway from all of this. The market does not care what you think is going to happen next. 8 years of Vanguard data and decades of Morningstar research tell a really consistent story. The investors who win over the long run, they're the ones who stop trying to predict. Build a good structure, automate what you can, keep your costs low, and then just go along for the ride. This is not exciting. It's not going to make headlines. No one's going to make a Netflix documentary for someone who started an account, set everything on autopilot, and then didn't touch it for 30 years. But guess what? The person who did that is likely to retire in a very good position. So build a good system, stick with it, and let inertia work in your favor. So what are your thoughts on the psychology of investing and not reacting to what the market is doing? I'd love to hear. Leave your comments down below. I post new videos every single week. If you got anything at all out of this one, please give it a like. If you're new here, please consider subscribing. Or if you know of someone who might get something out of this type of content, please consider sharing. I'll see you soon. Bye. I finally had to change the battery on my mic. So this is me testing it out. And also, who packages batteries? My goodness. Have you seen the way light bulbs are packaged? Fragile, fragile thing. Thin. Cardboard. This, 12 layers of plastic, thick cardboard, couldn't get into it for the life of me. So, just wondering on the philosophy behind the packaging. It is a reliable predictor. Maybe we can work with it a little bit. They required the most active decision. There is a bird out there. And if you know, you know. I'm dying. I'm going to go run outside and shoo this bird away.